Good afternoon, this is Neil Warren, and today I'm considering the recent VAT reduction from 20% to 5% for many supplies made by businesses and organisations in the tourist and hospitality sector. Now, this particular rate reduction is temporary, 15th of July to the 12th of January 2021, an inclusive period of 6 months. So from the 13th of January next year, we're back to 20% VAT, and the 5% VAT rate will disappear completely. These package of measures are costing the Exchequer £4 billion and are designed to promote those businesses that have been badly affected by the lockdown and the loss of income with the COVID-19 crisis. So a lot of things to think about. I'll focus on the practical issues regarding these particular changes. Now, there's three categories to consider as far as the change is concerned, and these are actually quite logical because with the legislation there's a new group 14, 15 and 16 into the reduced VAT schedule, Schedule 7A of the VAT Act 94. So on the slide there, first three, they are the three sectors: food and drink, overnight accommodation, tourist attractions. Now, when it comes to looking at these changes, try and focus on the what is being sold rather than who buy. And I know there was a school of thought on the food and drink category, totally wrong, that if it was only takeaway sales that qualify for 5%, if it was a business that also did on-premises sales. That is completely wrong. It's the hot takeaway food, so that can be relevant to a business that's got no seating area or on-premises consumption, exactly the same way as, for example, a cafe that does seating and takeaway both ways. We'll come back to that, but they're the three categories: food and drink, overnight accommodation, tourist attractions. VAT notices on the slide there, 70114, 7091 and 703093. The HMRC public notices have all been updated to recognise the key factors with the 5% rate. But the starting point I recommend for you is to go to Revenue and Customs Brief 10-2020, Google search on those words, and that gives you the links to both the public notices and some extra guidance issued by HMRC. The other source of guidance is the HMRC latest news in date order on their website, 9th of July, the day after the Chancellor's announcement on the 8th of July. The legislation was passed on the 14th of July with the statutory instrument introduced from the 15th of July, as I mentioned on the first slide. Right, let's look at food and drink to get things moving, and this is where we need to be careful about the difference between food sold on the premises of the business, and just be clear, premises relates to inside the business establishment and any specifically allocated seating areas outside the premises that belong to that particular business. So on-premises sales, very easy, everything is 5% VAT apart from alcohol. Alcohol stays at 20% in all cases, so nice and easy there. Takeaway sales, slightly more restricted, only hot food sold on a takeaway basis, fish and chips, pizza, Chinese takeaway, and hot drinks excluding alcohol. So hot coffee, cafe latte, tea, etc. all qualifies for the 5%. So what that means, very simply, is that for the rest of the items sold by the takeaway business, the VAT rate is unchanged. So let's look at an example, which I've repeated in the notes. A sale of a packet of crisps, fish and chips, bottle of beer, cafe latte, cheese and tomato sandwich. Nice and straightforward. On premises, all 5% VAT apart from the alcoholic beer. Now, a few accountants said, what about the crisps? That's not really a meal, but crisps still qualify as food, and it's the food which gets the reduced rate of VAT. So no problems with VAT at 5% on crisps. Takeaway food, the change affects hot food, hot drink. So the fish and chips, the cafe latte are now 5 rather than 20 as hot food, hot drink, and the latte, of course, is not alcoholic. The other items stay with the same rate of VAT. Alcohol, 20%. Crisps is an exclusion to zero rating on food, just like ice creams and chocolate bars, still 20%. And cold takeaway food, such as sandwiches and rolls, has always been zero rated and continues to be the case. Little tale, I got a question from an accountant about toasted sandwiches, and his question was, would it make sense for my client to toast their sandwiches, they were a takeaway outlet, rather than serve them cold to get the 5% VAT? Well, yes, he's correct. The toasted sandwiches are hot food, therefore 5% VAT, but the process of toasting scores a VAT own goal because you're taking it away from cold takeaway sandwiches, zero rated, into 5% hot toasted sandwiches. So the process of toasting means, yes, you get the 5% VAT, which before the 15th of July would have been 20, but you've taken it out of zero, and zero, as we know, is always the best VAT outcome. For a small business, this creates a number of challenges. For example, staff training. If, for example, the cashier has to decide button 1 standard rated, button 2 zero, and now button 3 for 5% VAT, that puts responsibility onto the cashiers. They need to ask the customer, as always, is it takeaway or on premises? If it's, for example, a sandwich bar with on and off premises. If it's a pre-conditioned till where the cashier just enters the product on the till screen, like cafe latte or crisps or fish and chips, then the programming of the till will make it much easier, just moving 20% to 5% in the till program for the relevant goods. Let's look at overnight accommodation, hotels, B&Bs, guest houses, motels, holiday cottages, holiday accommodation, campsites, caravan parks, etc. Now, the actual process of 5% is fairly straightforward on this category. The key issue, which has caused some confusion, is how do you deal with effectively prepayments made by, let's focus on a hotel, where a guest has already paid a deposit or even possibly the full payment for their booking, which was paid before the 15th of July, so 20% VAT, but their actual supply, when they attend the hotel and enjoy their stay, is in the 6-month window covered by the reduced rate. Now, there is good news here, but there's quite a lot of conditions to be aware of. VAT notice 700 para 30.7.4 to 30.9.2. I'll explain this process by looking at 2 different examples, and the difference between the 2 examples is one where a business adds VAT to its sales, a bit like we as accountants do. We charge our clients, say, £100 plus VAT, and I'll look at another one where a smaller guest house prices on a VAT inclusive basis and doesn't issue invoices, like, for example, many seaside guest houses. Let's look at the first one. Hotel booking, £500 plus VAT in March 2020, deposit received. Now, the receipt of money or an issue of an invoice in advance creates what's known as an actual tax point, VAT due at 20% because the 1st of March we were still at 20%. The basic tax point is when the goods or services are actually delivered or consumed by the customer. And this particular holiday is week commencing the 1st of August. It'll be enjoyed when the temporary rate applies, 5% VAT. Now, easy enough on the balance, the customer still owes £500 plus VAT for the other 50% of his booking. So nice and easy, invoice for the balance, £500 plus £25 VAT, 5% in August. Now, the supplier, the hotel, has the option to use this basic tax point concession regarding the advance deposit. And the process to do this is specifically explained in para 30.7.5 of the notice. The VAT credit note to the customer of £75 must be issued within 45 days of the VAT rate change, so 45 days after the 15th of July. So credit notes must be issued by, I think that's the 28th of August. And that VAT has to go to the customer. So the customer's paid VAT back in March, £100, possibly claimed input tax if it's a business stay. The customer now gets the £75 VAT back, and the hotel reduces his output tax on the VAT return that includes the credit note. So the customer wins on this situation. They now only owe £450 in August rather than £525 because of the credit note. So just to remind you again, that important time deadline, 45 days within the change in the VAT reduction, i.e. 45 days within the 15th of July. There's a summary of the VAT returns for this hotel. Output tax of £100 on their March VAT return if they're on calendar quarters, and then minus £50 on the September VAT return, covering the August transactions, 25 minus 75. The other example is the bed and breakfast that takes a deposit in advance, so £50 in January, that doesn't mention VAT, a £400 balance in August, again, no VAT mentioned. Again, this business is entitled to take advantage of the VAT concession of the basic tax point, so all at 5% in August, so the true liability is the total stay of £450 at 5%, VAT inclusive fraction 1/21. Less the output tax paid on the deposit at 20%, £8.33. Output tax to declare on the VAT return that includes August being £13.10. So hopefully that gives you that clear audit trail of how to deal with advance payments or advance invoices that straddle the VAT rate change. Admission to tourist attractions. What is a tourist attraction? Very complete list in the legislation, as on the slide there. Similar cultural events and facilities is the one that might cause a little bit of confusion. This is the sweep-up category, where something is still a tourist attraction, but not specifically one of the other very clear headings. The notes of HMRC give an example of a botanical garden falling within that category, which makes sense. Similar cultural event and facility. I thought of my own example of a pier on the seaside, or at the seaside, probably because I've been on a pier the week before and I was thinking about it while I was paying my £1 admission fee. Again, the pier, Victorian facility, tourist attraction, gets lots of visitors. Again, in my opinion, no problem. It qualifies as 5% as a similar cultural event and facility. Mixed supplies could be a practical challenge. HMRC's guidance gives practical examples. Now, when you look at mixed supplies, just be clear, the approach to adopt is ask the question, are you supplying one main supply with others being incidental, and therefore the VAT charge is wholly based on the main supply? Think about the perception of the customer. Does the customer expect two different supplies or one main supply with bits added? That indicates mixed supply if there's double expectation. And if you do have a mixed supply where the goods are at different rates of VAT, you can output tax a portion on any fair and reasonable basis. So let's think of two examples for a pub. Pie and a pint, the special offer, say, pint of beer and a pie, hot pie for £6. That is a mixed supply because the customer clearly expects both the food and the drink. So 5% hot pie with the temporary VAT reduction, alcohol 20%, as I mentioned earlier. Gin and tonic, if you have a gin and the bar person adds a splash of tonic to the gin, then that is a single supply of an alcoholic drink. The tonic is adding to the flavour and enjoyment of the gin. If it's sold in two separate measures, so the measure of gin is in the glass and you buy a separate mixer bottle of tonic water, totally separate, that is a mixed supply with output tax apportionment 5% on the tonic. Let's look at three other issues to conclude the session. Flat rate scheme for small businesses trading with less than £150,000 of taxable turnover. Three categories have come down to reflect the fact that those businesses are trading at 5 rather than 20 in many cases. Catering services, including restaurants and takeaways, 12.5% down to 4.5%. Hotel accommodation, 10.5% down to 0%. And pubs 6.5% down to 1%. I suspect that not many pubs use the flat rate scheme because their turnover will normally be greater than 150,000. And bear in mind that that figure of 150,000 for the flat rate scheme has never increased since 2003 when it was first introduced. So it stood fixed at that amount for 17 years. The challenge for many businesses is, do they reduce prices, let's get the right way, reduce prices to pass the VAT saving on to the customer or increase their profit margin? Now, if they are adding VAT on, like the example of the hotel, then yes, they must charge only 5% VAT. But many businesses like coffee shops charge obviously a VAT inclusive amount. So a cup of coffee at the moment at £3.60 with 20% VAT will be effectively £3.15 with 5% VAT if the savings passed on to customers. But it's fine for business owners to see this as an opportunity to recover some of the profits they've lost with the coronavirus crisis and keep the prices unchanged on their menus and their offerings or websites, and effectively increase their profits with the VAT saving. Final point there, the £10 voucher scheme. This is where for the month of August, on-premises restaurants can discount meals, not alcohol, to customers and get a £10 refund from the government per meal. The £10 coming back into the business is part consideration for the meal, which is a 5% meal because it doesn't include alcohol. So all those £10 will be subject to 5% VAT. I've made the figures nice and easy there. 21 vouchers, £210 refund from the government, £10 output tax on the next VAT return. Okay, some very interesting issues with this rate reduction. I have to say, on a personal level, the legislation and the guidance from HMRC and the general principles are much more straightforward than back in 2012 when we last had VAT changes involving food. So hopefully with these issues I've covered, you'll be able to progress and account for the correct VAT for your tourist and hospitality clients. And that concludes this session.